All right, everyone, welcome to the week one of our course content. So, before we start, I want to remind you that this course is built on the assumption that you will at least have a brief reading of the required chapters before you watch this video. Because I will be going through all the important points from the chapter, but I won't be repeating everything that is already written on the textbook. Okay, so make sure that you at least spend 1 hour, 2 hours reading the chapters that is assigned to you, and then we are ready to begin this video lecture. All right, I'm gonna share my screen, and there will be a PowerPoint. Okay, and there will be a PowerPoint slide deck for each chapter. Okay, and where I'm going to summarize all the important points from each chapter and go over those particularly confusing point of knowledge that I want to emphasize for your understanding. All right, I aim for this video lecture to be the runtime to be around 30 minutes to 1 hour, and we'll see how it goes because I'm recording every week. Okay, let's see. Okay, let's get started with chapter one. Chapter one, the title is Goals and Governance of the Corporation. Why do we have to talk about the goals and the governance of the corporation before we start talking anything about finance? Right. The first reason is that corporations, as one important form of business entities, is the main player of all the financial activities in the modern world of finance. So before we even start talking about what is finance, what is the key concepts in finance, we need to understand what is corporation and how is it different from the other form of businesses, and what kind of characteristics that make corporation a unique identity in the financial market. Okay, and then we're going to talk about the governance of the corporation, because the poor or good governance of the corporation actually is going to be a lot of topics you see from the financial news. Okay, and that's going to be the last part of the course. Okay, so for this chapter, we have five main topics. First of all, we're going to define what is a corporation and who is the financial manager in this corporation, making the key decisions in a corporation. Okay, and the financial manager makes two types of important decisions. One is investment decision, and the other is a financing decision. And then we're going to talk about what is the goal of the corporation. And then we're going to talk about that whether any misalignment of incentives between the owner and the managers of a certain corporation is going to affect the corporation performances. As we mentioned before, the corporation is one form of business entities. As you read from the chapters, you will have an idea that before corporation, we actually have other forms of business entities. Okay, the most commonly seen one is called the sole proprietorship. The sole proprietorship is a single person becoming a business entity. So there's no separation between personal and company assets and liabilities. That being said, whatever the company owns belong to the business, belong to the person who started this business. And all the income is taxed at personal level, meaning that if you start a sole proprietorship, you are personally responsible for all the liabilities of the company. And all the income, the profits of the company is going to be taxed at your personal income level. Okay, so you're filing one tax return each year. Your income from all sources, including your income from this business. And partnership is not much different from a sole proprietorship, except that there are multiple owners rather than one single person. Okay, and income is also taxed at personal level. You and your partner who is jointly starting this venture is going to share the income, and from according to your previously had arrangement of percentage of ownership, and then all of your income is going to be taxed at your personal income level. If you're at the 30% tax bracket, all of your income is going to be taxed at this bracket. Okay, we're going to talk about taxation in chapter 3 when we talk about accounting and finance. And corporation, the most distinct feature of a corporation is that it is a legal entity separate from all of its owners. What does it mean? Think about it. For sole proprietorship and partnerships, the person is the business and the business is the persons. There's no separation between the business and the owners. But in corporation, it is as if we have created a separate legal entity, which is standalone from the owners. Okay, what does it mean, a separate legal entity? It means that it can perform a lot of legal and business purposes on its own, and its owners is not liable for the activities of the corporation. Okay, for example, the corporation can enter into a contract with another person or another corporation, and this is the liability. This is the obligation of the corporation, but not the obligation of the owners. If the corporation betrayed the contract, violate any laws, the corporation is liable itself, but the owner is not personally liable for all the activities of the corporation. And that is one benefit because you basically created a shield before the owners and all the responsibility of the corporation. But it does come with a cost. First of all, it takes a lot of startup funds to incorporate your business. Depending on how large your business is going to be, incorporation is always going to cost some money. Okay, and then when you have your corporation, you're going to generate income from your corporation. The income coming into the corporation is going to first be taxed at the corporate level as a form of corporate income tax. And again, when the corporate is ready to distribute income to their owners, this revenue is going to be taxed again at the personal income tax level for the owners. So basically, this is called double taxation. You're going to pay tax twice on the same amount of money. That's a major disadvantage of corporation as a business entity. So let's define a corporation. A corporation is a business organized as a separate legal entity owned by all of their stockholders. Okay, you gotta have this article of corporations before you incorporate your business, in which you're gonna state your purpose, management, financing, etc. And the corporation have two types. In the stock market, we often talk about public companies, where all of their shares is floated on the stock market, and any information from the stock market is going to be reflected in the price changes. But we also have the private companies, where their shares are not floated in the public market, but rather shared by a group of investors. Okay, so that's what we call private corporations, or closely held corporations as compared to public corporations. Another key feature of corporations is that the shareholders from the company, the shareholders are the owners of the company, they elect a group of representatives for themselves, which is called the board of directors. The board of directors is a subgroup of the shareholders who will make decisions on behalf of all of the shareholders, and they have the responsibility to find professional management for the firm. So the board of directors representing the shareholders to hire the CEOs, CFOs, and the management team of the company. Right. Typically, we see that when the firm start up, it will be started as a sole proprietorship. Okay, the mom and pop shops, and then later when they grow bigger, it expand to partnership, and as some other people want to join in the business, and then they're gonna incorporate when, especially when the financing needs, the needs for funds grow larger than what can be financed by the few owners or the only owners. So they want to expand their access to finance. And also when the separation of ownership and control is necessary. For example, if you have a family firm and that you have been running this family firm for multiple generations in your family, but now the newest generation doesn't want to be involved in the daily management of the company anymore. So they want to still be controlling the company, still be only shares in the company to share in the profits, but they don't want to get involved in the daily management. So that's typically when they will hire professional management, and this is only possible when you have a corporation. Now we're ready to discuss the 4 key features of the corporations as compared to other form of business entities. The first one is limited liabilities. Okay, as the owner of a corporation, you are not personally liable for the corporation's liabilities. What does it mean? It means that when the corporation enter into a debt contract, the corporation can default on this debt if the corporation file for bankruptcy. As the owners of the corporation, you're not liable to repay the debt that the corporation has entered into with the debt holder. Okay, and because the corporation is considered a separate legal entity, it's the legal person. It does not transfer its liability to the owners. It has its own liabilities, and their liabilities disappear as long as they can file for bankruptcy. The second one is so the limited liability is actually a benefit of having a corporation. Okay, it's considered one of the advantages of a corporation, and it's actually one of the main reasons why the business owners want to incorporate their company. The second one is a drawback, which is double taxation. Because when income come into the corporation, they have to be taxed at the corporate level and again at the personal level. Okay, basically you're paying tax twice. But for some corporations, for example, the S Corp, there is no double taxation. But there's some limitation about which companies can be considered a S Corp. We have more details to follow. Okay, the third feature is the separation of ownerships and control. Like we said before, the owners can still have ownership shares in the corporation, but they do not control the corporation's daily management. They can hire professional management teams. Okay, so there is a separation of ownership and control. But this separation is not very obvious if you have family firms where the owners, family members in the company still controls the firm. Okay, whenever the family firms start to hire an outside member into the daily management of the firm, we begin to see separation of ownership and control. Right. 4 is perpetual life. This is related to the third point, separation of ownership and control, and the fact that the corporation is considered a legal person because it is a standalone legal entity, or you can consider it to be a lifeless person. Its lifetime is not limited by any one of the member of among the owners. As long as the company exists, the company keep operating, it can have a perpetual life, as compared to a sole proprietorship that when the owner died for a sole proprietorship, or when the partners in a partnership dissolve, the life of the partnership or the sole proprietorship ended. For corporation, theoretically, you can have perpetual life as long as you don't file for bankruptcy. Okay, there are more details about the tax treatment toward different types of organization. If you think about it, when you are choosing between different forms of business, the majority reason, the most important reason is what is the tax treatment. Okay, and as we're gonna see later, or I have referenced in the slides, when you are ready to start your own small business, for example, as college students, we can be tutor to high school students or students even younger, especially during the pandemic. We're stuck in the house anyway, so why not log in some educational platform and start tutoring? Okay, that is all really good business opportunities. But should we incorporate our side habit or our sidekick as a corporation or a sole proprietorship? Or what is the difference? Why should we start a company when we're making money on the side? And what is the business entity? What is the form of the business that is optimal for our situation? Those are all the different considerations. And it's all come down to how the tax is going to be different. It all comes down that how much we can retain as revenue without raising a red flag for IRS. Okay, we're not going to go into the details. This is for the benefit of your knowledge. We're not going to test on the details of the individual company formations. And there's actually a lot of hybrid businesses. If you think about it, when we go to a dentist, the dentist office is what we call a professional corporation. And those corporations have limited liabilities. But those professionals, most typically lawyers, doctors, etc., they are still personally liable for malpractices. So when the dentist didn't treat us appropriately, okay, when there's a malpractice, there's a medical accident, we can still file lawsuits against the doctor, the dentist, as a person. But if we like slipped in front of the dentist's office, and that is an accident, and this is actually going to be covered by the insurance on this corporation, not by the personal insurance of the dentist. Okay, so this is all kinds of hybrid business organizations that fits different needs of different type of businesses. If you're interested, go into the link and find out what is the differences between the different business entities. Okay. All right. Like we mentioned, when we are trying to decide whether to incorporate our business, in other words, whether to turn our sole proprietorship or partnership into a corporation, there's a lot of trade-off in this decision. Here I have listed 5 trade-offs. First is how much is your need to separate personal and corporate liabilities? Okay, how much protection do you want from the corporate business activities? Second, what is the tax implication? Are you saving money from tax or are you paying more taxes? Third is the cost of upfront and ongoing administration. Having the corporation registered, you need to draft the articles of corporation. You may need to pay registration fee to the state where you are incorporating your business. There's some upfront cost. And you have to hire lawyers who file your tax return on an annual basis, and you gotta pay your registration fee on an annual basis. So there's ongoing administration cost. Okay, the actual amount of the cost depends on your actual business, whether your company is public, is a public company is always cost more, how large the company is, how much employees you hire, and something like that. Okay. And the fourth, which is actually another really important reason to incorporate business, is to increase the access to financing. When you are a corporation, there is separation of ownership and control. So anyone, especially when it's a public company, anyone can become a shareholder of the company. So by becoming a shareholder, you're contributing capital into the company. So the access to financing is more widespread if you are a corporation instead of a sole proprietorship or partnership. I'm going to talk about this real soon. Okay, and of course we have to have a long-term view. When we first start the business, we might be happy with a mom and pop shop, a food truck. We don't think it's a good deal to just incorporate our business because of the upfront cost and the hustle of it. But we need to think about the long term. Are we thinking about expanding our business in the next couple of years? And do we have increased need to financing? Okay, so that's all factored into the decision whether we should incorporate the business now. Okay, so additional resources about different type of business organization. I'm going to share the slide on Blackboard. If you're interested, by all means, click into the resources and watch or read the articles and the videos. And if you have additional question, we have our weekly live chat, which is it should be on Fridays. There will be details in the syllabus and also on Blackboard that we can have further discussions of anything that you're interested. All right, now we have defined corporation as a special form of business entity. From this point on, most of our discussion is going to be taken from the perspective of a corporation rather than the other form of business entities. Now we're ready to discuss the persons or the team who make decisions inside of corporations. We call them the financial managers of the firm. Okay, we call them financial managers because they are involved in the decisions which is crucial to the company's financing. And we are actually generically referring to the financial managers, to the decision makers in the firm. Okay, because when you are a for-profit organization, everything comes down to the bottom line. You gotta make decisions that is beneficial for the company, its profit generating abilities. Okay, and by financial managers, we mean top management or decision makers. We don't really differentiate whether you are in finance department of the corporation or other departments. Okay, and the primary functions of the financial manager or financial decision maker are including two types of decisions. One is to raise cash in the financial market. In other words, to get money, to get the funding that the company needs. We call this the financing decision. Okay, and the other decision is where to spend the money that you have raised. We call this investment decision or capital budgeting decision. Where does the money go? These two decisions are the two crucial decisions in the company, but they don't necessarily come in order, right? Sometimes we have already decided where we should spend the money, but then we have to worry about where does the money come from. Okay. So traditionally, we have this structure of the team of financial managers. The top is the CFO or Chief Financial Officer, who is the top accountant from the firm, making all the financial decisions in the firm. And working for the CFO are the treasurers and the controllers. Traditionally, the treasurer is responsible for financing, cash management, and relationships with banks and other financial institutions, while the controller or comptroller is responsible for budgeting, accounting, and taxes. But this is most of the time this is no longer the case because organizations today is becoming flatter and flatter. We don't typically see those many layers, especially in startup. There's one person making the majority part of the decisions, or there's a few persons already a corporation or even a public company, but they don't have so many layers, or they don't have distinct roles in the company. So nowadays, we use the term financial managers to refer to the broad team of financial managers or anyone who is involved in financial decision making in the company. All right, like we said, the financing decision is the decisions on the sources and the amounts of financing. Where does money come from? We got funding into the firm, and then the investment decision is about the decision to invest in assets. Where do we spend the money? Well, if you think about it, we are talking about a firm. The financial manager is making this two type of decision. But if we were talking about a person, this is also the two type of financial decisions that a person have to make on a daily basis. What do we want to buy? And where do we get the money? Right? So, well, we oftentimes coming into finance with the assumption that finance is a highly complicated, highly abstract topic. But if you are able to connect the logic of the financial world with your personal transactions each day, you will see that it's not that counterintuitive. There's a lot of commonality between your personal life and the financial world. Okay, we're gonna have more of examples in that along that line in the future class. Okay, this table gives us a list of the recent transactions of a few major players in the financial market, all important large public companies listed either in the UK or in other markets around the world, right? And we're going to see that a lot of activity, almost all of the activities that financial managers perform in the corporations can be grouped into either financing decisions or investment decisions. For example, let's look at the first one. We have Delta Airlines in the US. And the example of an investment decision will be if they placed order for a certain number of Airbus airliners. Okay, they're buying something. And a financing decision that they have actually made during the recent years is they issued corporate bonds. In chapter 6, we're going to talk about corporate bonds. Okay, corporate bonds is a financial security, it's a debt security where the issuer or the borrower is issuing a group of financial assets in exchange for fundings today. So by issuing corporate bonds, you are entering into a debt contract with your investors. Okay, so this is a financing decision. And if you keep going down to the list, we have an example of airline company. And what about a Facebook? Okay, a new media company. An investment decision will be something like acquire another company. Okay, acquisitions is arguably the most important investment decisions that a firm can make. Okay, buying another company, investing in the assets, the human resources, the intangible and tangible assets of another company. And the recent financing decision will be like leasing a large new office building in San Francisco. Okay, we don't talk much about leases in this course, but lease is actually another form of financing. You're basically entering into a long-term contract with another party, where that you're gonna just keep renting this office. Okay, you lease this office to another party. Okay, Okay, I will need to edit this part. All right, if we could keep going down the list, we can see that whenever a company is buying an asset, it is considered investment decision. Even when you spend money on advertising, this is an investment decision as well. Okay, and yeah, here the Toshiba company in Japan. One of their investment decisions is actually to sell off its bankrupt US nuclear businesses. This is an investment decision. Why? Because instead of buying something, you're selling your asset. So it is a reverse of a investment decision. You're selling off your assets. And one example of a financing decision is to issue common stock and issue equity capital. We're going to talk about equity capital or stock market in chapter 7. Right. Equity is another form of financing. Basically, you are inviting the stock owners to sharing the future profitability of your firm in exchange for fundings today. Right. Make sure for the purpose of understanding and for exams from this chapter, you should be able to distinguish what is a investment decision and what is a financing decision from a particular firm. Okay, and you're going to see practice questions from your review and homework as well. Okay, we talk about the investment decision is to spend money, the decision to invest in assets. Then what is an asset? By definition, an asset is anything that is useful or valuable. It could be person, it could be things, or it could be a quality like reputation. Well, in finance, we are viewing the term asset from a more abstract perspective. That is anything of value or a source of value that can be converted into cash someday. We know houses, cars, machinery, and equipment are assets, but they're not the only form of assets. As long as something can bring us a stream of future cash flows, we consider it as assets. Okay, this perspective is really important for us because when we talk about financial assets, we think the financial assets has value not because they have a physical form, but because they give us a stream of future cash flow. And this is also really important when we talk about pricing or discounted cash flow in chapter 5. Two types of assets, real assets and financial assets. Real assets, we know is something concrete that we can kick, we can touch. And financial assets provides claims to the income generated by the real assets. Okay, real assets produce, they give us income. And financial assets give us claims to the profit generated from real assets. Stocks, bonds, certificate of deposits, IOUs, all examples of financial assets. Like we said, as long as something can generate a stream of cash flow for us, something can give us a claim to future cash flows, we consider it valuable and we call it an asset. We also have tangible assets and intangible assets. Note that this grouping is not mutually exhaustive. We can have real asset that is also a intangible assets, or we can have financial assets. We don't want to distinguish too much between these two groupings. Okay, we can just different standards of groupings. We can group assets into real assets or financial assets, and we can also separate them into tangible assets and intangible assets. Tangible assets are physical assets like factories, machineries, vehicles, and they typically have commonly recognized value. But intangible assets, they're typically something that cannot be touched, but they still have value, like brand name, reputation, copyright, patents, and goodwills. Okay? For example, for a major pharmaceutical company, the money we spend in R&D, research and development, is considered a intangible assets. Okay, because that's knowledge. We know that we're spending money into R&D. It might not produce anything immediately, but it's a chance that the company is going to have a new drug, and the new drug is going to get through FDA approval, and then it's going to commercialize to generate future cash flows, right? For example, the vaccine that most of us is getting or already got from BioNTech, Pfizer, Moderna, different companies, they spent a huge amount of money into R&D expenditures before they can get a vaccine approved by FDA. So those are their intangible assets. Okay, the assets, the anything that can generate cash flow in the future. All right, financing decision. Where does the money come from, and from who? And then, are we going to pay back the people who give us money initially? How much? We say that we are selling or writing or issued financial securities in exchange for financing. Okay, sell, write, issue all means that we're entering into a contract with our lenders. Okay, we are selling financial assets in exchange for cash today. All right, we talk about there were two choices for financing, debt and equity as the most common. And the mix of debt and equity financing in the firm makes up of the firm's capital structure, which is going to be talked about more in chapter 12. Well, in chapter 3, we're going to go into accounting and finance. But I think most of all of you guys have had a basic accounting class. And you know that what is a balance sheet. The balance sheet basically tells you what had been the decisions of the financial manager in terms of investment decisions and financing decisions. The left-hand side of the balance sheet lists all of the assets the company possesses at a certain point of time, typically at the end of the fiscal year. Okay, and the assets also list tangible assets, real assets, financial assets, or intangible assets. So this is the cumulative effect of all of the investment decisions the financial manager have made so far. On the right-hand side of the balance sheet, we have financing decisions because there is a mix of debt and shareholders' equity. The debt is listed on top and the equity is listed in the bottom. All right, so by looking at the balance sheet, we have an idea of the financing and investment decisions the managers have made so far. And we don't know bankruptcy. Bankruptcy happens when all of your assets cannot pay off your debt. Your shareholders' equity drop to zero. More on bankruptcy later. All right, so what is the role of the financial manager? We know that the financial manager is making financing and investment decisions. They raise funds in the financial markets by selling financial assets or securities to investors as a part of the financing decision. And then they invest this cash in real assets. The decision as to the amount and which assets to acquire is called an investment decision. So basically, it's where does the money come from and where does the money go? The money goes to assets we want to buy. The assets could be intangible or tangible. And where does the money come from? We can either raise the money in the form of debt, or we can raise the money as the form of equity. But of course, we can use the money we generated from the previous round of business activities. Right. This chart describes the ongoing circle of the two types of decisions the financial manager have to make. Before business activities even begin, the financial managers need to raise their first round of fundings from their investors in either the form of debt or equity. Right. So in number one, the investors give the funds to the financial managers, and in number two, the fund is invested in the firm. And then the firm's gonna have their own operations. Okay, they have invested in real asset. The asset is gonna generate profits, and the profits is going back to the firm. And the financial manager need to make the second round of decision of where does the money generated from the business activities go. They have two choices. They can either retain the money into the next round of business activities in 4A. Cash can be reinvested, or they can pay the cash back to their investors, canceling the financial assets, writing down their financial assets, decreasing their obligations. Okay, and there's a trade-off between whether we should reinvest the cash raised or paying back the investors. We call this the investment trade-off. Well, in what situation do you think the manager should keep the money in the firm? And in what situation do you think the manager should give the money back to shareholders? If we think about it, from a financial perspective, we want to make every dollar to the best place. We want to put every dollar to the best place, so this $1 can generate the highest return in the next round. So for a financial manager, if I'm looking at the money the company has, my decision ideally should depend on whether reinvesting in the firm can generate a higher return than if I return this money to my investors. The investors gonna spend the money themselves or invest the money in other opportunities. Okay, the investment trade-off depends on whether a financial manager can add value if they put the funds into the firm's future investment, as compared to the return that the shareholders can generate by themselves. All right? If I am an Apple computer, I made a lot of money selling iPads and computers, iPhones in 1 year. And then if I think I reinvest this amount of money in my next generation of iPhone, I can generate a higher profit than what can be generated by my shareholders by investing in other companies. Okay, for example, I have two choices. I can either invest in the next round of Apple products, or I can pay my money back to my equity or debt investors and let them invest in Microsoft or another company. If I have the confidence that my investment decisions is better than my shareholders' investment returns, I should have reinvested the money into my own firm. But if I think there's not sufficient opportunities in my firm and the industry is saturated, the competition is high, it's not growing very fast, the rational decision is to give the money back to my investors. So my investors can take the money, invest in the next hot thing, for example, Tesla or Zoom. They can make their own decision and they can generate more returns. Okay, that is an investment trade-off the financial managers have to make. Okay, so now we have defined what is a corporation, what is a financial manager in the corporation, and what are the most important decisions a financial manager need to make. Then we need to think about what is this all about? What is the central theme? What is the ultimate goal for a financial manager in making those decisions? Okay, we're talking about for-profit organizations here. We're not talking about NGOs or charities or educational or colleges and stuff. We're talking about for-profit organizations. The ultimate goal with for-profit organizations is to maximize the value of the corporation. Okay, and if you consider the corporation, the business, as a pie, the financial manager's job is to make this pie larger by adding value, by generating cash flows, So the size of the pie, you can think about the size of the pie as the present value, as we're going to talk about in chapter 5, of all the future cash flows this company can generate in the future. Okay, so the size of the pie or the value of the company depends on the firm's cash generating capacity today and in the future. And it's not just about this year's profit. It's about the future, all of the future cash flows from this company. Remember that we talk about asset as all of the future cash flow this asset can bring us. The value of the asset depends on what kind of cash flow this asset can generate for us, for the owner in future. Okay? But if you think about it, if the company is the pie, who owns the pie? It's going to be the shareholders. Who are the shareholders? They're the equity holders. And why aren't the debt holders owners of the company? Well, because the debt holders get interest and they get repaid of the principals, and they don't have any relationship with the company anymore. Okay, we're gonna talk more about the difference between debt and equity as we go into chapter 6 and chapter 7. Okay, more on that later. Okay, now we are ready to discuss one of the central theme of corporations, which is called the agency problem. So what is the agency problem? Well, whenever you need to have somebody else do something for you, there's gonna be the possibility that this person is not going to do the thing exactly as you wanted. Okay, because you two are two different person. You have different incentives. You have different situations. You're maximizing different values. If we consider the different incentives that can happen between the owners of the company and the managers of the company, we're talking about agency problems. Agency problems arise whenever the managers of the company, who are hired by the owners of the company, are not doing things to maximize the owner's value or the shareholder's value. We call this an agency problem. The agency problem is a natural consequence of the separation of ownership and control, right? And the agency problem, because the two parties have different incentives. And the agency cost is what we define as the value lost from agency problems, or the cost that we have to incur in order to curb this agency problem. Right? There is going to be solution. There is some solution for agency problems. Okay, but sometimes they have to incur a amount of agency cost. Two of the major solutions is executive compensation and corporate governance. Executive compensation encourage the company to tie the incentive of the manager to the owners by offering the managers some stock options of the company, or just basically tie the performance of the company's stocks, the increase in the company's value, on the compensation on the managers, so that when the managers working hard for the owners, they're working for themselves as well, basically making the managers one of the owners. Okay, and especially after the most recent financial crisis, the financial reforms, the Dodd-Frank Act, give U.S. shareholders more control right on the executive compensations. Okay, and basically the shareholders can vote in favor or against a compensation plan, whether they think that the compensation for the executive is fair or not. Okay, and corporate governance is it's what we talk about, the laws, regulations, and different institutions, and the corporate best practices that protect shareholders and other investors. The SOX Act of 2002 requires some board of directors members to be independent, which means that the board of director members should not have a tie with the company. It should not be employees of the company. It should be entirely independent, so that when they make a decision, it's objective. Okay, and they also ask the CEOs and CFOs to sign off personally on the corporation's accounting procedures and results. Okay, basically putting the reputation of the management on the qualities of the information that the company provided to their owners or to their shareholders. All right, all of the efforts to solve the agency problems. And of course, in the effort to solve agency problems, we're going to incur agency costs. Has also been some discussion of whether the value maximizing decisions of the companies is ethical. Okay, that we can go into the quote from Adam Smith. Whether you think that the effort to maximizing someone's own benefit is actually doing well to the whole world, and that we can debate on. Okay, there's relevant chapters in the book. If you're interested, go read it. All right, then we have the summary of chapter 1. We talk about the two primary decisions of a financial manager. They include the investment decision and financing decision. There is 4 key facts about corporations which distinguish them from other types of business entities. And then we know that the ultimate goal of a firm or a corporation is to maximize the shareholders' value. And when the managers does not maximize the shareholders' value, it's considered agency problem, and agency cost is going to hurt shareholders' value. Okay, there's some other scene from chapter 1, and also in the book, the author discussed 2 cases to illustrate the importance of good investment decision and good financing decision. We're not going into details of the 2 cases because I find 2 cases as a package, but they are not, we don't have the copyright to distribute it in class. So I have basically summarized the 2 cases and put some videos over there. And those are optional, but if you have time, I encourage you to dig into these 2 cases and have some basically have a look at what is the takeaway from the 2 cases. To summarize, the first case, the HP case, is when we talk about how a merger and acquisition decisions can be very value destroying. If you find the wrong merger target, and this actually can be disastrous for the company. The second case, the TXU leveraged buyout, tells us that even though that most value is created by good investment decisions, a poor financing decision is going to rule a really good company. Okay, so that is for chapter 1. After this, you should go into the chapter 1, week 1 review and homework. The review and homework give you a chance to review the key concepts from this chapter and to do some questions. The chapter 1 is almost entirely conceptual, but as we go into the course, we're going to get more and more quantitative. So this chapter is make sure that you understand everything, you take away the key points. Let me know if you have any question, post your question on the discussion board, or if it's a more personal question, feel free to email me. All right, I'll see you next week. Bye.